Hey guys, hope you and your families are doing well. This is going to be a very boring video about trade management and what I call active risk mitigation. So we're going to be doing it on a stock which was actually on my focus watch list. Now I didn't target an entry here because I was looking for one more extremely tight day so I could just tighten up the risk a little bit more, but I'll be talking about the principles of what I call active risk mitigation from low pivot. So this is all about trying to position yourself beyond the possibility of defeat early on in the trade. Now when you're targeting these low pivots, there's a lot of nuances as well for areas you may be looking to free roll. So I warn you now, this video is going to be extremely in depth, extremely in the weeds, and it is not for beginners. These are very advanced concepts that I'm talking about. So let's start off with the trade identification, then we'll get into the initial controlling risk, then we'll get into the risk mitigation. So first and foremost, ticker 9. Why is this stock coming up on my screens? Why is it on my focus list? It's an oil and gas, it's a field services stock which is ranked about 4 out of 197 in terms of the Market Smith industry group rankings. Is clearly a very strong stock. Had a really nice rally up here around about 350%, pulls back down, shakeout demand tail onto the 21 EMA, bounces, puts in a higher low, another shakeout demand tail around the 21 EMA, tight inside day, and then in here, see how it's just starting to get nice and tight on the 10 EMA. Look how the volume is drying up, 52-week high today on the breakout, but the RS line had been turning up as well. So it's a clean moving stock, it's fairly liquid, has a recent history of being able to trend well. I like that because that there is then feeding into my trade management. I'm a believer in the most kind of reliable indication on how a stock is going to act on a future breakout is how has a stock acted on previous breakouts in terms of the trend. If it's a very choppy stock, so on the uptrend, is it doing this all over the place, then it's likely to do that in future. If it's a nice, clean, smooth mover right in those moving averages, I think it's likely to do that in the future. It's not a given, but I like to trade stocks that can make cleaner moves instead of choppy moves all over the place because they are just a nightmare to try and manage. So this is why this stock is coming up on my radar. I'm treating it like a high tight flag. I know there's some real sticklers for the rules out there. So the decline here from peak to trough to the low of that demand tail was around about 34%. But remember, this is a shakeout demand tail coming through here. So if we go to the close there, it's then into that 20-25% range. So for me, in this current market environment, a stock that goes up about 350% and then from peak to the close trough, if that makes sense, is around about 23%. That is an extremely strong stock, and I just like how it's setting up on these moving averages, higher lows, and then starts getting nice and tight over here. Multiple tight candlesticks, volume drying up. To me, it's just a sign that there is very little supply coming to the market. So this was one on my focus list, but my focus watch list. But I was just watching and waiting for preferably another day, really tight candlestick like this, with the volume just drying up. So it gets even tighter. I can then go in with initial stop loss of closer to 5% instead of underneath the low, the final bar closer to 7%. But I'm going to be talking about the active risk mitigation in a second. So that's the identifying, basically the initial controlling risk. Logical place for the stop loss would have been, again, it was still a little bit wide for me. I wanted to go in around about 5%, so it was just waiting for it to tighten up. But around about 7% underneath the prior two lows, underneath the 10 EMA would have been kind of the logical place. But initial stop of 7% in this market, probably not. Again, it's not necessarily always about the initial stop percentage. That's obviously very important, but it's more so about the total risk to the account. So in this market environment, I've been risking usually under 0.5% of total account equity per trade, but the mean is somewhere between 0.5% and 1%. So then obviously your position size changes according to the initial stop loss size. I've probably lost a few people. I said this video is going to be very in the weeds, so it is living up to the hype. So let's start talking about the active risk mitigation now. Certainly from these lower pivots in base. Now this isn't, I wouldn't necessarily say a low pivot. It's more of a mid pivot. So what I like to do very early on in the trades is try and remove all of the risk. Now from the low pivots and the mid pivots, I'm actually trying to free roll into the high of the base. So if you think about the logical kind of stalling out area, it could be around the high of the base. So let's just move this across, and I'm going to make this one here green. So I would be targeting it. I was obviously looking for it to just tighten up a little bit more, but let's assume that it was a really tight candlestick and I was actually like, yes, I'm going to target this one. So I would be using a buy stop limit order, stop with a stop loss attached. That's how I buy the majority of my positions, through $10.23. So $10.23 is the pivot for me. It is not $11.20. Why? Because supply has stopped coming to market around $10.23. This is where prices got nice and tight, so I'm expecting a quick explosive move through that level, which you can see is currently happening today, it means I can control the risk. So I can use a tighter stop loss that then feeds into the active risk mitigation. If my stop loss is tighter, if the area on the chart is tighter, that means I can free roll more quickly, more efficiently, which is what I'm trying to do. So it's a Sun Tzu quote, art of war: position myself beyond the possibility of defeat. I would add, as soon as prudently possible. So how on earth do we go about positioning ourselves beyond the possibility of defeat? So let's say here, and now what I'm going to do is confuse a lot of you, give you multiple different scenarios for how you can think about active risk mitigation. So these are the important levels to remember, and I'm just going to write these down for you. So if you want to sell half your position, okay, that means you could free roll at 1R wherever your initial stop loss is, or wherever your new stop loss. Now, when I'm working through the phases of identifying nice high ADR here of over 10.5%, that's really quick. That's really good to see, and I'll talk about that in terms of the active risk mitigation on why you want to focus on these faster mover, higher ADR stocks. So 1/2 at 1R, you could sell 1/3 at 2R, or you could sell 1/4 at 3R. These are the levels to free roll. Now this here can be your initial stop loss, so 1R wherever your initial stop loss is, or your new stop loss, because you could be pushing it up. You could have a sell limit order higher in the market, so you're selling here and then pushing your stop loss up. 1/3 at 2 times wherever your stop loss is, or 1/4 of your position at 3 times wherever your stop loss is. Could be initial, could be new, could be staggered. Again, it depends. There's a lot of variations here. As I said, it's active risk mitigation. So my kind of philosophy here is, how can I position myself beyond the possibility of defeat, knowing at which levels do I want to free roll, and each trade is unique in terms of whether it's a low pivot, a mid pivot, where the higher the base, what is the percentage there, is it prudent to try and free roll there, is there then a logical place to be moving my stop loss up to? And then what I'm trying to do is free roll early on, and then I'm trying to capture this. And you would have heard me talk about, in terms of my sell rules, I'm trying to ride some of the key moving averages. For the quicker names, that's going to be 10-21 EMA. However, if I think the stock starts getting extended from the 10 EMA, and potentially it's gone on a run of a couple 100% or whatever it may be, kind of depends on the nature of the stock as well. A couple 100% in Amazon would be extremely high, but a couple 100% in a volatile biotech stock may not be. So it's also the context of the individual stock, right? But let's say on this day here, if you had bought it, let's say, you see how it gets tight in here. Let's say you bought it here. This is kind of a nice trigger bar as well. Imagine this is a 5-star kind of 10 out of 10 setup coming through here. You buy it here, okay? So you could probably free roll fairly early on, maybe even on the first day, but certainly in here you could free roll the trade, which is what we're going to be talking about over here in a couple of minutes. I'm jumping forward a little bit in terms of the optimizing profits, so you can kind of understand the whole process, and then we'll really get into the weeds over here. So imagine on this day here, you'd entered it, you'd free rolled it here, then you're riding the 10-21 EMA. Here you might go, oh crikey, this is really extended here. I'm up on the position 120%. I should just sell everything. Do you have any reason to sell anything? The stock's acting great, 52-week highs all over the place. So what I found in my own trading, and just from studying thousands and thousands of these, rather than just randomly selling because I think, oh, the stock's up 30%, 40%, I got to sell it. What I would much rather do, lower the day, choke it off. Maybe all the position, maybe part of the position, depends how the position is playing out. So if I went lower the day, I'm going to be stopped out somewhere in this vicinity, somewhere around here, depending on kind of how much leeway you gave it, just underneath the prior low of the day. But something like that, I find for myself much more effective rather than just trying to guess. I will let the stock decide. I'd much rather go low the day. This is much more of a Darvis concept as well. He never had any reason to sell a rising stock. I think that there is a absolute golden nugget from Darvis's book. So I would rather, if the stock's still rising, low the day is much more effective in my view. So obviously I'm trying to mitigate the risk early on, and then try and sit for a nice big intermediate term trend. I'm an intermediate term trend follower. I'm trying to ride that intermediate term trend. So what I'm trying to do is early on sit like this and then try and ride that intermediate term trend. So let's start getting into why you clicked on this video, active risk mitigation. Right, so there are a couple of variations. Now what I want to do is just pull this over here. I'm not sure where I'm going to place myself on the screen in the video recording, but what I want to do as well is now just enlarge this like this, so we can just get really focused on the parts that I want you guys to focus on. So we have a couple of options here, right? If we went stop loss underneath the low of the last couple of days, underneath the 10, that would be around about 7%. So if we wanted to free roll, we would need a 7% gain, and we could sell half of our position at 1 times 7%. So if we had a 7% gain, now these figures work when you're in single figures. Obviously losses work in a geometric fashion against you. So if you had a 50% stop loss, actually to then be break even, you'd need 100% gain if you then got stopped out on the remaining shares, the remaining half. So again, what I'm saying here is applicable for single figures. I think if your stop loss is 5%, you actually need a 5.25% gain to then be break even on the remaining parts. But that there is extremely in the weed. Let's just try and stay with the broad concept here. So if I wanted to free roll and sell half of my position, obviously with a 7% stop loss, I would need to sell half of my position at 7%, right? If I wanted to sell 1/3 of my position, so I still had 2/3 left, I would need 2 times my stop loss. So for this instance here, would be a gain of 14%. If I wanted to sell 1/4 of my position, I would need a 3R move of my initial stop loss, or wherever my stop loss was. But in this instance here, if we were using 7%, we'd need a move of 21%. How? Let's start talking about it. We're buying potentially here a lower pivot within the base. So the first thing I would be looking at is, where is price first likely to stall out? And you can see it's already stalled out here today. It may push on for it, but it's stalled out into the high of the base. So let's just take a reading there, and let's just say roughly, I'm going to say this is 9%, okay? Because I would then be a couple cents underneath the high. So I just want this to actually say 9. So let's just do that. 9%. There we go. So what I would be thinking here is, and again, you have to have some imagination here. Now, first and foremost, I'd be going, it's getting nice and tight. As I said earlier on in this video, I was looking for one more really tight trigger bar so I could push this initial stop loss up to closer to 5%. So what I then like doing is focusing on the ADR of the stock, because I like to free roll trades as soon as prudently possible, remove all of that risk. So then what I have to do is kind of understand, is a 2 times move wherever my initial stop loss is, or where I'm bumping it up to, is that going to be achievable for the stock? So here, if I went into the prior high here is around about 9%, is that achievable for this stock, and how quickly is that stock likely going to be able to achieve it? Well, the ADR of the stock is above 9%, is over 10.5% here. So does it sound plausible that the stock may be able to move 9%, 10% in a single day? Yes, because that is the 20-day ADR of the stock. So that there is good. If the stock only had an ADR of 1% or 2%, then it may take 10 days, it may take 5 days, it may never happen. It may just turn around really quickly. Obviously, you can get stopped out on breakout trades a lot, and as is happening this year in a hostile market environment. So looking at the ADR and then kind of thinking that through with how quickly you're able to free roll trades as well. So generally speaking, on the slower moving stocks, you want to have tighter stops. It wouldn't really make any sense having a 7% stop on a stock that has an ADR of 1.5%. It just wouldn't make any sense really. So what I'd be thinking here is, okay, I could be buying the stock here at $10.23. So that there would be my trigger price, if you like, with the buy stop. So let's say my entry is here, and I get filled at 10.24 as price moves through here. My initial stop loss is then going to be placed here. Now, this is then just another side point. I told you we're going to go into it. So what I would do here is I would place my stop loss just underneath the $0.50 level. So instead of being at $9.50 or $9.51, I would be just underneath. So for this purpose, let's just go at $9.57. So I would be here, and let's imagine that there is a 7% stop loss. Now what I would be doing is thinking, if price moves into $11.20, that's potentially the first stalling area. So this is much more applicable. Instead of a higher base breakout, this is more applicable for a low pivot or a mid pivot. So you're buying it when price is tightened up in the during the potential lows of the base, in the middle of the base. Such is the nature of a low pivot, mid pivot. If you want to learn about those, you can go and read Minervini's books. So what I'd be doing then in here is I'm going to put a sell limit order in for 1/3 at the high was 11.20, so let's say 11.17. So I'm going to sell 1/3 of my position here. So let's just then take a look at the reading. So 10.24 and then 11.17, like that. So around about 9%. So then what I'm doing, yeah, I'm thinking out the trade, trying to remove all of the risk here from this stock. I want to lose no money on it. I want it to do no damage to my account equity line. So then what I'd be thinking is, if price gets to near as damn at $11.20, $11.17 in this instance where our sell limit order is, does it seem plausible that I could move my stop loss from 7%, which is kind of my max risk on the trade? This is the absolute maximum that I'm willing to lose on the trade. Does it seem plausible that I could move my stop loss from 7% to 4.5%? Could I take off a couple percentage risk points? Sounds plausible, doesn't it? So if we were to then pull it up, and let's then pull this up to around about 4.5%, our stop loss is then going to be placed up here like this. So what we're doing is then we're imagining how the trade may play out. And again, our objective is to free roll as soon as prudently possible. So in here, I could have my max stop loss. This is my max initial risk on the trade. Then what I'm saying is, okay, if I get filled where I want to get filled, then in here, I'm going to have a sell limit order at $11.17. I'm going to sell 1/3 of my position, and simultaneously on the remaining 2/3, I'm going to push my stop loss up now to around about 4.5%. That's still underneath the 10 EMA, and it's still underneath a nice round number of $10. Now, when I have done that, had I taken the trade today, this is probably how I would have done it. But as I said, I was looking for one more really tight day to be coming through. So instead of that initial stop being 7%, it could be closer to 4.5%, because then I could have free rolled into this level without actually having to push up my stop loss. But this is the nature of active risk mitigation, and it all comes back to invincibility. Another Sun Tzu: invincibility lies in the defense, possibility of victory in attack. Trading is all about playing fantastic defense, positioning yourself beyond the possibility of defeat. Now, because when price is up here, again, it's good to do this video here because you can see the candlestick. It wouldn't now really look good if price came all the way back down here, would it? Why do I need to let a stock that's had a gain of 10% come all the way back down to a 7% stop? I don't need to do that. Okay, I can free roll into that pop, then I can try and sit for a testing action and then see if I can play the stock for a bigger move, as we were covering earlier. So then I can free roll it in the first day, then I can try and sit and allow the immediate term trend to play out, having very little stress on the position. I free rolled it, great. Can the stock now go on a big run, and I'm there for nothing if you nothing if you like. This is another kind of concept covered in Minervini's book. He calls it improving his worst case scenario. This in essence is how I go about improving my worst case scenario, thinking about that active risk and mitigation very early on in the trade. So I'm planning this out before I even enter the trade. I'm thinking of levels. Where do I want to free roll? Do I need to then push my initial stop loss up? Can I free roll keeping where my initial stop loss is? How is it then playing out? Is there a shakeout to Montel? Is there a key moving averages that I want to be above, below? All of these all of these different things. But I always think the market is trying to teach you one of two things. It's basically trying to teach you to improve your risk management skills, or it's trying to teach you to sit better in positions, and it's usually either end of the spectrum. So that is it, guys. I've probably rambled on there for enough about a very boring concept, but a very important concept, which is active risk mitigation, all focused on kind of positioning yourself beyond the possibility of defeat and free rolling trades. So thank you very much for watching. If you made it to the end of this video, have a very good time over the festive period, and I'll see you in the next video.